everyone. Thank you for joining the RWA panel. We've got a hot topic today, and I'm expecting sharp answers from our panelists. My name is Mihai. I lead protocol research at Messari, not at Galaxy Digital. However, I'm very happy to be welcomed by our four panelists today. I'm going to ask each of you to quickly introduce yourself and what you do.
Yeah, hi everyone, I'm Katie Wheeler. I head up partnerships at Ondo Finance. Ondo Finance is the largest tokenized US Treasury provider with over 550 million of TVL.
Michael Marcantonio, I head up Galaxy's DeFi group. Galaxy Digital is a crypto-native financial services company. We're publicly traded. We have largely 5-6 divisions between trading, asset management, Bitcoin mining, staking. We're registered broker-dealers. We have an investment bank, and we have ventures funds.
I'm Martin, CEO of Mountain Protocol. We are the first regulated yield-bearing stablecoin, backed by T-bills as well. Essentially like a USDC with yield, with all of the crypto features that you would expect from a USDC, both from transferability perspective, but also mint redeem capacity.
And I'm Charlie Yu, one of the co-founders of RWA.xyz. We're the leading data and analytics platform for tokenized real-world assets. So if you're ever wondering what kinds of assets are out there, you know, these guys have listed assets on our site, or how much are things worth, or how big are things? Those are all the sorts of questions that we answer on our site.
All right, thank you for introductions. We've got Larry Fink speaking about tokenization very often. We've got also DeFi protocols referring to potentially something similar, but with the term real-world assets. So I wanted to ask each of you, what do you understand through real-world assets? How do you define it? And potentially, how is that different from the tokenization term that Larry Fink is using?
I can go first for that. So the way we think about real-world assets is anything where the token represents an IOU of something that really exists in the real world that is enforced by laws of a nation state as opposed to the laws of code. So that would be the first real-world asset was dollars. That was USDT, then USDC. Those are still the biggest real-world assets. Then we have kind of yield-bearing T-bill style products. You have gold. You have a bunch of other assets coming on chain. Obviously, most of the world is managed by nation states today. So most of the world is real-world assets. A lot of those IOUs are expected to come on chain more and more. And I think the job that we have all here is how do we accelerate that so we have more of those.
And to add more color to what Martin said, agree with everything that he said. There's broadly two kinds of tokenized real-world assets. So the one that Martin was talking about is one that we broadly call reledgered or tokenized assets, where you're taking an asset that exists off-chain and then you're wrapping it in a token version. Then you also have more native on-chain assets that are packaged and originated natively on-chain, and they wouldn't exist actually without a blockchain. So that broadly is things in the private credit space. So Figure originating home equity lines of credit and originating those natively on-chain, or Maple and Centrifuge, who do all of the lending, again, on native blockchains. Think of it, similar analogy to how Ethereum or Bitcoin wouldn't exist without a blockchain, whereas and that's the sort of distinction between the two kinds. And they broadly have different applications, different benefits. A natively on-chain asset has cost savings associated with it, and then the more tokenized assets like what Martin and Katie, their companies, bring on-chain, the benefits mostly are around accessibility, using DeFi, collateral mobility, and things like that.
Yeah, to echo all of that, definitely stablecoins found the first product market fit for tokenization. But I think there's a lot of other opportunities outside of just US Treasuries. There's also art, there's agriculture, there's commodities. I believe Galaxy tokenized a violin, some very expensive violin, in order to get leverage on it. So I think kind of the world is kind of endless with the opportunities that we can bring on chain.
Yeah, the tokenization of the violin was interesting. Basically, a client came to us. It's like, hey, I've got a very expensive violin. I think it was Catherine the Great's violin. Former leader of Russia, I believe, in the 17th, 18th century.
Unsanctioned.
Yeah. Back when we didn't have sanctions on Russia. No. And they wanted to up their collateral, so we tokenized violin. I think that was a really interesting paradigm for the future of tokenization and RWAs. If you can, like, for example, you've got a $1 billion wine market. If we could tokenize wine, many people love, we love to drink wine, but at the same time, a lot of people love to collect wine. Well, it's kind of clunky to buy wine, store it, and retail is not great at collecting wine and storing wine. There's probably businesses out there that love doing that and have specialization in that, but they don't want to ship it. Right? If you could tokenize the wine, you could tokenize Nikes, you could tokenize any collector item. Of course, there's going to be a trusted intermediary, but the efficiency gains that you're going to get, I think, are really exciting. So there's that on the consumer and retail side. I think on the structured finance side is really interesting as well. There's a host of different efficiencies we can gain through structured finance, through securitization, through credit that the blockchain is perfectly situated to do. I mean, the North Star from my perspective is the tokenization of securities, right? Like, securities used to be pieces of paper you got representing ownership of a company. They got rid of the piece of paper. Now it's just on a centralized ledger. So we just have to make one more step to a decentralized ledger, and that's what we're pushing for.
All right, you mentioned tokenization of securities, tokenization of commodities as well. My next question is, what are some challenges in the space that you guys deal with, and how do you actually address them?
I think there's a few. The first one I would say is regulation. Being a US-based crypto company, you can imagine it's a little challenging to navigate at times. There's no stablecoin law in the United States, at least not to date. So the way that Ondo approaches things is they just comply with securities law. So we have a product called OUSG, which is issued as a Reg D, so you have to be a qualified purchaser, aka an institutional focused product. And then we also have something called USDY, which is a Reg S offering. So it's an offshore offering, so me being in the United States, I can't touch it, but it's great for emerging markets and it's retail facing and there's no high minimums or maximums. The other one I would say is education. Like, I think a lot of people don't really understand the nuances of every single different stablecoin. I think the way that we structured USDY is very exciting because not only do you get the yield, but you also have a lot better investor protections. It's bankruptcy remote, there's third-party oversight, it's structured as senior secured debt, so you actually have claims on the underlying assets. And so I think the market has matured over time, and I think people are willing and looking to that. And so I think we're trying to bring the best of TradFi into DeFi and the best of DeFi into TradFi. And then the last one is liquidity. Liquidity is king. It's the most expensive and hardest problem to solve. I would say we really try to focus with partners, market makers, bridges. We don't want to fragment liquidity, but it's definitely something where you have to get 0 to 1 and then 1 to 5 and 5 to 10, and it's not an easy thing to kind of get that flywheel in effect.
Yeah, regulation is the biggest issue. It's no surprise that the last 4 years, the U.S. government and governments around the world have been at war with crypto. First the strategy was a containment strategy, cut off crypto from the financial economy generally, and then of course regulation through enforcement, which you just start suing every DEX, every blockchain, every centralized exchange, and scaring everyone else out of the market. And it has hurt, but I think we are turning a corner in regulation. I actually think the RWA market would be absolutely massive right now and mature if it was not for the regulatory uncertainty. I think people want this. I think it's an obvious use case. And it's going to happen, but we need a little bit of regulatory certainty and a little bit of breathing room from regulators that are trying to, that see it as an existential threat to the traditional financial economy, which I wouldn't characterize it as an existential threat. I would say it's an optimization and innovation, and it's very disruptive, but we need that in our financial system today.
I would say the other thing is not just regulation in the US. The US is the center of the world in terms of finance. Every dollar that you ship will touch a US bank or has a bank that has a US correspondent. So it is the center of the financial world, but you also have 179 other countries that have their own regulations. I feel for the US, this is going to be a big win. For some of those countries, it's not going to be such a big win. I think if you see what Nigeria is doing with Binance, what Argentina is doing with the dollar, Venezuela, like a ton of these countries, I think it's going to get good when we have clarity in the US, but I think it's going to get hairy with the other 179 countries because people are going to be opting out of those markets and opting in on more mature and better markets, which is better for citizens. We'll have to see what happens there. And I think MICA is the first, did the first step there, where for stablecoin specifically, they didn't optimize for user security. They trade-offs for holders to make sure that deposits stayed in European banks. So essentially built riskier products for European citizens in order to support the bank. So you're going to see more of those things happen. So yeah, I think the regulatory guide is going to be very good for building, but we're still not going to be out even if we get like FATE Act and Stablecoin Act in the US this year or next year.
To add another data point to the US regulation picture and the impact that it could have on the tokenization environment, when you talk to the various banks that, of course, do the vast majority of asset origination and issuance in the US, a lot of them are explicitly talking about how the tide has turned in favor of using public blockchains and wanting to use public blockchains for a lot of their own work. And that's just because inherently the banks don't really trust each other, and so you sort of have the Schelling point where they'll converge into public blockchains, because you can imagine that if your counterparty is JP Morgan, you might not want to use the blockchain that's entirely controlled by them. And so a lot of the banks want to be able to use this technology, but there are structural barriers in place that prevent them from being able to do anything. I mean, they can't even hold something like Ethereum to use ETH without having an equivalent amount of cash on their balance sheet to match it. There's just crazy laws like that are preventing a lot of this.
Right, so I hear you. You mentioned regulation, you mentioned policymakers, you also mentioned banks, and that's exactly what happened in Zurich last week at Point Zero Forum. There was a gathering of policymakers, of banks, also of DeFi protocols. They were coming together to discuss a lot of topics around tokenization. And I was pleasantly surprised that the dialogue from the regulator side was very open, and they were inviting protocols for education. Now, a spicy question for you. What do you do in that matter? Do you engage with the regulator? Do you speak to them, or are you waiting for someone else to do the work? Where do we stand there?
I can jump first. So I would say, at least for the US, you have some parts of the government that are very open to speaking with projects. There are some people, Tom Emmer's office, for example, I think they spoke with most everyone on stage. So we do speak with those. I would say there's other parts where you have to be more proactive. I think that's where startups are probably less active, and kind of bigger companies, Circle, Coinbase, are taking the lead there. But yeah, I think it's everyone's job to participate. I think the kind of putting the cost of the lobbying effort on startups is not our area of focus, right? So it's going to be very, very hard. I think for the bigger players, it will be good to actually organize these things for all of us to participate.
Yeah, I think we need to engage with the regulators. I mean, there was an ethos in crypto for many years that, we are almost outside of the regulatory environments. We don't need regulation, right? Like, the law is the code. And I have always been a little skeptical of that. I am a lawyer, and so I see everything is inherently legal. Like, property is legal, and digital property cannot escape the legal regime in which it operates. Now, crypto's unique in that it's global, and so it intersects with many different regulatory bodies and regulatory regimes. But we didn't do a good job for 10 years or so after Bitcoin, I would say, in like really productively engaging with regulators. I think that's changed. I think we are now actively engaging with regulators, and we need to continue to do that. In fact, regulation doesn't necessarily have to be a detriment to growth. Regulation often spurs growth. One fact that I like to cite is when the seatbelt in the US was mandated for automobiles in like the 50s, all of a sudden you had a massive spike in automobile purchases because men felt more comfortable letting their husbands felt more comfortable letting their wives drive now. And women felt more comfortable having their children in the car, right, with seatbelts. So there was a net positive there to that regulation, even though it had a direct cost to automobiles in the short term. I think if we have a comprehensive and fair and reasonable regulatory regime in the U.S., like what we're seeing in MiCA in Europe, it's going to be a massive, massive catalyst for our industry. So we do need to engage regulators. And Galaxy engages with regulators quite often, and we need to. It's an education piece. We have to educate regulators. It's also a paradigm shift, right? Like the security laws in the US were written in the 30s and the 40s, and they were designed for a very different time. Your average consumer of securities in the 30s and 40s is very different than one today. And so it's a little bit about getting them educated with the changing dynamics, but it's also a project in getting them comfortable that new paradigms for regulation will not blow up the financial economy and that they will work.
Yeah, I think it takes a village, and if you don't have a seat at the table, then you have no control of the outcome. So I think it's imperative for all of us to do our part.
Awesome. Thanks a lot for the answers. I also think it takes a lot of effort, but it is worthwhile doing. Charlie, I'm going to pick up on something that you mentioned before, that banks are also bound by regulations, and especially settling on a public ledger comes with definitely advantages in terms of risk assessment, in terms of faster operations, cheaper, better, faster, pretty much everything. Now, the question for you is, what do you think could be settled publicly, and what do you think could still be done off-chain so that it is still compliant to the current regulations? In terms of implementation, where do we stand there?
Yeah, it's a good question, and it really sort of boils down to the how you view the benefits of the different types of tokenized assets that I mentioned before. Where, let's say that if your primary value add of a tokenized asset is cost efficiencies in the packaging, origination, securitization, then doing that on a private ledger gives you all of those benefits. Right now, JP Morgan on their Onyx platform does, I don't know, maybe like billions of dollars a day in intraday repurchase agreements, and they're getting massive cost efficiencies doing that. But they don't care about making that product more accessible to, you and me, retail. That's for their other clients as banks or other financial firms, and for those clients, for JP's clients, there's no reason for that to be on a public ledger, and that's actually one of the reasons that JP Morgan started with that use case, because it's not made any better by doing it on a public chain, really. But again, if you're trying to increase the accessibility of a lot of these assets to retail, especially in emerging markets and other places around the world, then it definitely needs to be done on a public blockchain.
I think also about the public blockchain, the scale of innovation in public blockchains is so much faster and so much more dynamic than any private blockchain. Any Onyx private blockchain that JP Morgan could develop, you've got thousands and thousands of developers in a decentralized way building public blockchains, right? So Onyx's blockchain, I think, is a fork of Ethereum's from like 2016, 2017, right? The public blockchains have a massive advantage in that they will be more dynamic and more efficient and scale much faster. And so I do think that the adoption of, let's say, digital identities and other sort of new primitives to get banks comfortable with using public blockchains is a net benefit that we should be focused on.
Yeah, it's a really great point. It's sort of like in the equivalent in software would be you go to your dev team and you say, hey, you're no longer allowed to use any open source software. You have to do it yourself. You have to develop all this yourself. You can't take advantage of anyone else's work, which the government does in a lot of cases right now. But you can just imagine how much that would hamstring organizations and the pace of development, like you said.
Another challenge that has been mentioned by you, Katie, was liquidity. So my question is, how do we go about increasing liquidity and hence trading volume for RWAs? What are some practical means to do it?
Yeah, I think you have to partner smart. You have to work with market makers. You have to work with bridging tech. If you're going to deploy your asset on multiple blockchains, you don't want to fragment your liquidity across multiple. So I think it's one of those things where you have to be creative, but also you don't want to just throw a bunch of money at it and get a bunch of sugar highs, and then all of a sudden the capital just goes away. So you have to be, I guess, logical and thoughtful about it, but also kind of leverage your partnerships across the ecosystem.
And I think one of the things we need to accept as real-world assets, especially if you're tokenizing an asset that exists on New York Stock Exchange as a primary issuance, and then you're issuing an IOU on a blockchain, is that asset is never going to be that liquid on the blockchain. Tesla stock on chain will be very hard to have liquidity as if you were on the New York Stock Exchange. So then you have to think about how you build a product that uses Tesla stock that solves for that problem, and the added problem that you don't have trading time, like you don't have a price feed on Saturdays, right? Or the price feed on Saturdays, the off-hours trading is less reliable. So I think part of real-world assets is how do we start building without assuming 24/7 settlement of the underlying asset, and still protecting the holder and not having a lot of MEVV captured by smart players that have access on both markets.
Yeah, the fragmentation of liquidity is a gigantic problem, as we all know, and it's probably going to be worse before it gets better with the L2 thesis. Companies come to us all the time, which L2 should we deploy on? I mean, I generally don't know. And there's a lot of really thoughtful, smart people who are working on bridging, and we need to figure out bridging. Bridging is a really important piece of this. But fragmentation of liquidity should be something that over time gets better with better bridges, with better oracles, with better and more competent and more sophisticated capital providers. Right now, if you have access to a lot of capital, you have to build stuff in order to be on Injective, right? In order to be on Ondo or Mountain. And that takes time, and that takes money, and that takes engineering resources. And no matter how efficient protocols can make their SDKs to interact with a different protocol, institutions and institutional capital allocators are going to take even more time to vet it and figure it out and make sure that it's safe. So I think there's just a little there's a little growing pains right now. I'm dealing with this at Galaxy, where we're building frantically, and we are spending a lot of time building integrations with different protocols. That's probably the longest thing, and then we can unlock capital. Once it unlocks the capital, then we have to monitor and manage the fragmentation of our capital, because we would ideally not like to have capital split across multiple different blockchains. In different heterogeneous state machines that have different rules on each machine. We would prefer alls being equal to be able to integrate our capital through one wallet and self-custody it. But that will come over time, but it's not there yet.
There's also just some assets that are inherently where people on both sides, liquidity providers and takers, really want this to happen. One example might be on lending against fine art, where it doesn't exist yet today, but you talk to a lot of these, like Sotheby's and Christie's, and a lot of the people who do the pricing behind them. One that comes to mind is Artery. Art Ori, and they are one of the biggest people that do evaluations on this art for the large trading houses. And they'll tell you that they get a lot of clients, especially from large, like private wealth management in these larger banks, coming to them and saying, hey, like we would love, this art is extremely valuable and it's going to stay valuable. Art has been one of the best performing asset classes on a risk adjusted basis. And so there's people on both sides that want to get liquidity on that. And also on the other side, people are more than happy to lend against it because they're willing to get that 5% spread above SOFR. And people are very happy to make that happen. And it just needs someone to step in to actually facilitate that market. Compare that to liquidity on real estate, which is a meme in crypto where people sort of like want it to happen, but have you ever thought, oh, gee whiz, I wish that I could, put my house on chain and like let other people trade it? It's just not really a problem on either side of the market.
Yes and no. Sorry, not to push back on that last point, but like, when you own a house, what do you own? Well, at least in the United States, what do you own? You have a deed, right? And if you've ever interacted with your local deed agency, it's extremely inefficient to do property and title checking, right? I mean, and the reason it's inefficient is because the government runs it for the most part, and they have outdated systems. So you could imagine a world in which your deed was on the blockchain, and maybe in a ZK way that was confidential, and you'd have to pass certain checks in order to access it. But you could imagine like being able to sell your house much easier simply by selling your NFT deed, right? This world could exist one day. And if you can do that, you can have real contracts on chain, right? So imagine you're buying a company and your merger agreement is not a piece of paper that's 300 pages long that nobody likes to read, but it's a digital smart contract. And instead of having to hire a transfer agent, you simply load USDC into the contract. When the conditions are met, they're executed and USDC is automatically transferred. And in exchange for the USDC, let's say, the company that you're selling, their securities are just NFTs, right? Each security is just an NFT. And you transfer those NFTs to the holder. And that's the entire system. As an M&A lawyer, I could tell you that would be incredible. When I first got to Galaxy, one of the first deals we did, it was a small deal, but we just sent USDC. And this is the most amazing thing ever. We don't have to have the banks involved. We don't have to get a closing call where we have to do wires and everything else. So a massive RWA area is like in legal type stuff, like merger agreements, like bonds, right? A bond could be on chain, and all of the different legal aspects of that bond are also on chain. Intellectual property is really important, right? You could trade IP rights. Actually, we're not very far away from that, right? If you buy a Bored Ape, you don't own the IP of the Bored Ape, you own the token, and the token points to an image, the intellectual property of which you don't own. But you could own it, theoretically, right? You could just put the ownership into the metadata of the smart contract and say whoever holds this token owns the corresponding IP. That's actually a pretty simple change. And if you could do that with a Bored Ape NFT, you could do it with intellectual property rights of all kinds. And that's really an exciting area that we should be thinking about.
Yeah, I think fractional ownership is a big unlock. I think the traditional 60-40 bond portfolio is kind of dead, and people want access to other investment classes like art, real estate, and so I think that'll be a huge unlock for individuals.
Mm-hmm. So lots of great examples here. How do you guys make money?
Speaking here.
That's highly confidential. No. You mean how do we make money in RWAs? From a trading perspective, it's being a liquidity provider. It's being a market maker. It is being a resource for protocols and for institutions to connect. It's also in tokenization, right? Like the tokenized violin. That's a very interesting example. There's a lot of different ways to make money. I mean, my North Star in all of this is like, when are we going to get securities to be tokenized, right? When are we going to get truly the derivatives market to be tokenized, right? When that happens, first of all, we will all be very well positioned in that economy relative to traditional economy. Every single TradFi hedge fund, when securities are now traded on chain, will have to update their systems and go through the very painful processes that we've been dealing with for a number of years now in building on-chain stuff. But at the same time, the tokenization of securities will just be more efficient, right? Again, securities today exist on a centralized ledger. We just need to move them to a decentralized ledger. And so I think all the traditional ways that you make money in TradFi, right? Once we can tokenize securities, derivatives, and other real-world assets, we're going to be able to have a real advantage in that economy.
I would say the ways you make money on real-world assets are the same that you make money in the traditional sense. So as an issuer, you make money the same way. As a trader, it's similar. As a market maker, it's similar. I think the big difference with crypto is because of the operational efficiencies that it brings and the scale that it brings, the margins get compressed, but the volume is a lot bigger. And that compression of margin is what makes the product more attractive for everyone else. And that's, in the end, surplus for users in the economy. So it's net positive for the economy. I think the adverse effect that it will have is you don't need 5,000 banks. You probably need 20, right? You don't need hundreds of issuers. You probably need 20. You probably don't need 100 issuers of a oil ETF in 180 countries. You probably need in 1 or 2 countries, right? So there's a lot of consolidation to make trading easier and to lower costs, which essentially it's better if you're the consumer of that product.
Yeah, at Ondo, we just think of ourselves as an asset manager who leverages public blockchains. So we, collect a 10-bit management fee. Definitely not going to make anyone wealthy unless you get to scale, but that's kind of how Ondo approaches it.
Yeah, I think broadly you can think of it as like Michael said, you're moving from centralized to decentralized ledger, and so you can imagine that it would be the Euroclears and the DTCCs that will be the ones that will really have to change up how they make money because they're no longer being paid to maintain that centralized ledger. But yeah, broadly speaking, everyone will make money in the same way, and like Martin said, there'll just be a lot more opportunities that are enabled by having things on a decentralized ledger that people can make way more money on because the volumes are just higher, there's more use cases, more liquidity.
I'm going to pick up on what you said, Martin, with respect to consolidation. I think consolidation needs standardization, so adhering to some standards. And I think we're currently quite far away from achieving standards, even on the DeFi side, not to mention actually bridging DeFi and TradFi. How do you go about creating a standard that is commonly used by, first of all, the DeFi world, and then afterwards, bringing it to TradFi?
Yeah, I would challenge that. So I would say, if you look at most banks in the US, for example, which is where my expertise is, they all use a couple of providers for their core platform. But once they implement it, they never upgrade it, and they have custom code. So you technically have 5,000 different APIs for each of these banks. And that's why you have a company called Plaid that essentially their only job is to standardize those APIs. In crypto, we have the ERC20 standard, which basically it's what both Ondo and ourselves use. And that standard doesn't require any kind of core technology because you just leverage the Open Zeppelin smart contract and you inherit the security and the lindiness of the ERC20 across everyone else who's been using it. So I think in crypto, we're actually pretty well off in terms of actually standardizing. I think we move slow versus what we expect in the speed of crypto. But generally, when a new standard is needed, there is a lot of industry collaboration to actually get one out of the gate. So I think standards is actually one place where we're actually pretty strong as an industry, and it allows you to build once and replicate.
Well, actually, the bankers say the opposite. The bankers say that they need to have a standard where you have, who is the issuer in a very, very specific code. How can I find them? What has been transferred, by whom, when, and so on. And actually, in between them, they are not able to come to the scheme, to the same schema, actually, to agree on a transfer of an asset. What do you think about that?
So I think the delta between that description and what we think about the standard is if you're trying to fit TradFi into DeFi, it is not going to fit seamlessly. There are some things in DeFi that you use different assumptions. I think the biggest assumption difference that you have in crypto that you don't have in DeFi is in TradFi is the settlement and the need for an intermediary to settle. And that makes the settlement of crypto assets a lot simpler. And the interface, you don't need to go and then call your counterparty, Bonnie Mel, and say, hey, I didn't receive $100 million. You know it after one block, or you can confirm it after finality, but you do have that standard. The one thing I hear is compliance as one of the standards that crypto has not implemented in its ledgers. I think that we don't have still a standard for how we do compliance. And I think it's not going to be figured out by private entities because in the end, compliance is a regulatory requirement. I think the regulators are going to end up having to define, hopefully with contribution from industry. But in the end, the regulators will have to say, this is what you need from a compliance perspective. I'm bullish that I think we do compliance a lot better than TradFi, honestly. Like if you look at criminals, they don't use crypto. If you look at money launderers, they don't use crypto unless they are proceeds from a crypto hack. In general, it tends to be a very bad place to carry criminal activity. I think some politicians have figured that out, some have not. But I think in general, that compliance requirement that is inherited by traditional institutions is more of trying to fit TradFi into DeFi than actually figuring out the benefits of DeFi and crypto.
All right, parting thoughts. What should we do to bring RWAs closer to the masses?
I'm going to jump in. I think the use case needs to be very clear, and we need to build towards use cases where the customer is going to jump in despite any token incentives, where there's an actual use case that you can bridge. I think like any revolution, you start from the outskirts and you build in. I think JP Morgan is the last person that's going to actually need this at scale because they are the financial system. If you go to the edges where people have no bank accounts, where farmers have no access to hedging, where essentially loans backed by grain are very hard to get, I think that's where you start building that penetration. I think the efficiencies that crypto brings on kind of like the center on the New York Stock Exchange are marginally very small. So we'll have to grow from the outskirts in as opposed to try to revolutionize the New York Stock Exchange, kind of like as the first step in. And I don't know if, Mike, you agree on that?
I don't think, I don't disagree with that. I think the New York Stock Exchange is very efficient, and trying to replicate that on chain is kind of not really where we should focus much of our time. In fact, the private securities market just completely makes the public securities market look tiny, right? It is 10x the public securities market. And the private securities market is actually somewhere that crypto should be focused, because one thing that has come out of crypto over the last couple of years that I think is extremely exciting and really not discussed enough is how efficient DEXs are, AMMs are in pricing illiquid assets. Like before DEXs, we didn't have real price discovery on illiquid assets. And I can't think of a single other system out there that efficiently uses a market to price illiquid assets. And an AMM, a two-sided liquidity pool like Uniswap V2 or even V3 has become the market standard for pricing small cap tokens. Well, small cap securities could also be efficiently priced on an AMM. And that's the type of interesting unlocks that I think DeFi can bring, rather than just trying to compete with the New York Stock Exchange. What I think when I say tokenization of securities, I do think that public securities should ultimately be on a blockchain instead of a centralized ledger. They would still be traded through the New York Stock Exchange. The New York Stock Exchange would have to change a little. It would still be an order book, so we're a little far away from that. But ultimately, I think that is a future world that where we are merging the innovations of DeFi and CeFi in a regulatorily compliant way for the New York Stock Exchange type paradigm. But on the other hand, we can really go far out on the risk curve in terms of building DEXs and other exchanges for, like, let's just say, carbon credits, right? If you're a project finance, if you're in the project finance game and you want to build a solar farm, right? How do you raise money? It's extremely difficult, and it's extremely expensive. And what are you actually issuing? You're issuing effectively equity in a revenue stream, not equity in the project or the ownership. That is an interesting use case that we should be replicating on chain and tokenizing that. So there's a lot of different things. But to your question, like parting thoughts, and how do we bring the masses into this? I don't actually think it's going to be that hard to bring the masses into this. I actually think it would happen very naturally if the regulators would let us do a lot of this stuff, right? And it's not just the regulators telling us no. It's also the regulatory uncertainty that says to Nike, don't tokenize your new pair of Jordans. Don't put that on the blockchain. We don't like that, right? Disney, don't issue social tokens for Marvel characters that are freely tradable. We're going to shut down, NBA, the NBA NFTs, right? We're going to sue them out of existence. The holders of that are going to get pennies on the dollar, right? Like, these type of things make big institutions very reticent in the broad retail economy from doing what would be very natural to do, which is issue an NFT when a new movie comes out, which you can then use to pay for your movie ticket, which you then you can use to get points for other, adjacent, maybe a show will come out, maybe a Broadway play will come out. All these different things could be very easily done on chain, and we have the tech right now to do it. The question is whether Disney, a publicly traded company, is going to even broach crypto given the regulatory posture. So we need to do a very good job and continue to do a very good job of lobbying, of writing policy, of helping us shape the direction of our rules. And we have to be influencing who is actually in power, who is at these regulatory agencies, and it will happen over time.
Charlie, parting thoughts?
I think that in finance, people tend to overthink about how products should be built. At the end of the day, it's really just about solving problems for people. And if you look at what in the RWA space has the most traction, it's things like stablecoins in emerging markets where people can get access to dollars instead of just holding their rapidly inflating local currency. Or it's things like, again, going to like JP Morgan's Onyx intraday repo. Their clients, there was a lot of demand for people to lend against or borrow against treasuries intraday, and that previously wasn't possible without a blockchain because of the restrictions of T+1 settlement. And so it's just like anything else. We just need to find the places where there are real problems where this can be solved, instead of working backwards from the technology and trying to find a problem.
Yeah, I agree. It's real life use cases, real utility, and providing more benefit than what exists today.
All right, you've heard it. So it's about providing more utility. It's about regulations. It's about liquidity. And you've heard it from Michael that RWAs are coming to the masses. If you've learned something new in this session, please a round of applause for our panelists.